The distinct pleasure of introducing Dr. John Newton, who is Chief Economist of the American Farm Bureau Federation. And before we begin with the introduction, I'd like to first thank the American Farm Bureau Federation, with which the Farm Credit System and Farm Credit East in particular have a great relationship with, as well as the Northeast Farm Bureau Associations of the respective states that we serve. All are co-sponsors of this webinar, and we appreciate their support and their participation in this webinar. Moving on to introducing Dr. John Newton. He is the Chief Economist for the American Farm Bureau Federation based in Washington, D.C. The AFBF is the largest organization of independent farmers in the United States. In his role, Dr. Newton is responsible for the management of Farm Bureau's Economics Department and coordinates and conducts analyses used for the development and advocacy of Farm Bureau policy on Capitol Hill. Prior to joining Farm Bureau, Dr. Newton was an agricultural economist for the USDA and was detailed to both the Senate Ag Committee as well as the USDA Office of the Chief Economist. Dr. Newton previously was also an award-winning faculty member at the University of Illinois, Urbana-Champaign. He is a native of Kentucky, and he holds 2 master's degrees and a PhD from The Ohio State University. So please join me in welcoming Dr. Newton, and with that, I will turn it over to you, Mr. Newton.
Thank you so much, Chris, and I'm going to go ahead and try to share my screen here. All right.
Got it.
Well, I appreciate the opportunity to join everybody this afternoon. We've been engaged at American Farm Bureau for what feels like so many months now, working on issues that have popped up related to COVID-19. I think in mid-March, when the stay-at-home orders and social distancing guidelines first went into place, we began to identify issues. Our State Farm Bureau surfaced issues almost immediately on challenges that were impacting farmers and ranchers. And we have weekly calls with all of the State Farm Bureau presidents. We have weekly calls with all of our national affairs coordinators to continuously highlight any challenges that may be emerging across the countryside. President Zippy Duvall is in constant communication with the administration. He serves on the White House task force to reopen the country. He's in constant communication with the secretary. I believe President Duvall was with the secretary this week in Georgia to do an event with respect to the food box program. And we've been in constant communication with folks on Capitol Hill, identifying the needs of farmers and ranchers, whether it be through the Paycheck Protection Program or the relief packages, the CARES packages, and the HEROES Act, which we expect to be taken up in the Senate, or some sort of aid package in the Senate in July, we believe. But we've been working on this for some time, and I think all of the various state farm bureaus, we've tackled a number of challenges. I think the first thing that came to us was the H-2A issue, which we worked with the State Department to deal with that. The issues with our meat processing plants, we've been actively working on those issues. Issues with respect to cattle markets and the spread between wholesale prices and live cattle prices, interest in investigating that with the DOJ. We've been in constant communication with the CFTC as well as the CME. So just about every single issue that touches agriculture related to COVID-19, we've been very, very engaged in. So I'm going to highlight, some of our observations from a farm economy perspective, and then talk about some of the provisions in the most recent coronavirus food assistance program. When we think about where we started 2020, I think folks were looking at the farm economy. We were still in a down farm economic situation. USDA's Economic Research Service had projected for net cash farm income to fall in 2020, really on the back of less trade aid. There were zero expectations for more trade assistance in 2020, but farmers were optimistic. You had the phase 1 agreement with China, you had USMCA, you had the US-Japan trade agreement. We knew that we were going to have, a rebound in crop production after a pretty devastating 2019. Milk production was expected to be record high. Red meat production was expected to be record high. So we knew that 2020 was shaping up to be a race between supply and demand. And with these trade agreements, I think a lot of our members felt like we were rounding third, heading into home base, and we thought maybe there's a light at the end of the tunnel. And Professor Jason Lusk at Purdue put it pretty bluntly with respect to that light at the end of the tunnel. He said that was the light of a freight train, and that was the coronavirus. And I think in mid-March, after we're in the 8th year of a down farm economy, the trade war certainly provided headwinds to the farm economic situation, and with the coronavirus, it was just pretty devastating for many of our producers around the country in terms of the effect of what it's done to their businesses, what it's done to their commodity prices. So again, we've been very engaged, and I think one of the things, we have had conversations with Mr. Van Hoos at the Farm Credit Council. Thank him for participating with our State Farm Bureau presidents, answering the questions that they've had on credit access around the country in response to COVID-19. I know we've been on a number of letters with the farm credit institutions up to Capitol Hill, really supporting their efforts as well. When we think about COVID-19, and we successfully, in my opinion, flattened the curve. But as cases began to accelerate, the social distancing, stay-at-home orders, the effect on gasoline demand and people driving, all of that happened immediately, and it had a very, very significant impact on many of our commodities. And when you think about agriculture and our food supply chain here in the United States, a very, very efficient system, a just-in-time delivery system for many of our livestock products, in that when a market-ready animal is ready for processing, it's processed and most likely in your grocery store very quickly. Milk on the shelves is probably 2 to 3 days removed from a farm, if that. So we had a very, very efficient food system, but more than half the food in the country was consumed in restaurants and schools. And so when you shut down schools, when restaurants go to carry out service only, you close off a pretty big chunk of the supply chain. And a good example, let's think about pizza shops. They're buying 30-pound bags of mozzarella. If their business has declined, that mozzarella business has declined, and that plant's just not fabricated to make packaging for the grocery store, at least not all of their lines. I was on the phone with Idaho Farm Bureau. As soon as this happened, frozen French fries, the food distributors canceled all the orders. So then you had potatoes backing up in inventory when you're going to have a new potato harvest this fall. So across the supply chain, you had challenges emerge. On the dairy side, you had a lot of processing facilities that lost business. School milk demand cratered. And so you had milk being dumped across the country. I think that was the challenge that we immediately observed, is the difficulty in pulling all the product that went through the food service sector through the grocery store. And we did see some panic buying. I think when you look at grocery store sales, they were $73 billion in March and $63 billion in April, up about 15% from pre-COVID. But the restaurant demand cratered, and it fell by nearly 50% between February and April. So I think this amplifies the supply chain challenges that began to hit agriculture. When you talk about farmers having to plow under fruits and vegetables because they lost a customer, just about every sector of agriculture had very, very difficult challenges when you lose that restaurant business. At the same time, when you think about in-store clothing sales, I know the Northeast isn't a big fiber producer, but when you see clothing sales drop by nearly 90%, the demand for cotton and cotton products fell sharply. And so you've seen cotton prices fall. They've rebounded somewhat with manufacturing activity picking up in some of our Southeast Asia partners, but cotton prices fell dramatically. Cotton exports to China are below the levels they were in 2017. So that's really hurt those producers as well. I can't think of too many of our members that are actually doing better off today than where they were pre-COVID. But the only folks that have called and said things are a little bit better, folks that were going direct to the consumer, direct marketing. Some of those folks have reported record sales because more and more consumers want to go direct to their food supply and direct to their farmer. When we think about what happened to the ethanol sector, they had the Russia Saudi Arabian oil war, which led to increased oil production. That led to lower oil prices. As a matter of fact, the May oil futures went negative for the first time in history. We do see negative future values from time to time in the electricity industry, but not in the oil space. But that pulled down ethanol prices. And with ethanol prices losing 30 to 40 cents a gallon, that pushed ethanol plant profitability into the negative territory. And so many ethanol plants around the country began to idle their processing capacity or shut down. And when these ethanol plants are shut down and idle, they're not buying corn. And ethanol chews up about 30 to 40% of the U.S. corn supply every single year. And so you immediately saw cash corn prices across the Corn Belt weaken due to lower ethanol demand. Now, what we've seen in recent weeks is gasoline demand has picked up as states start to reopen their economies. Gasoline consumption has picked up. Ethanol production has accelerated. And then we don't have the burdensome inventory levels that we once had, a month ago. Right now, ethanol inventories are sitting about 2% above year-over-year levels. So I think getting these plants back up and restarted, there's in the HEROES Act that was passed out of the House a couple weeks ago, there is a support package to help the ethanol plants by paying them, I believe, 45 cents a gallon for everything that they produced from January through May, I believe. So that would help the ethanol industry, help them get back up and running, help some of these plants, recover from their COVID-19 related losses. Now, we don't know what the Senate's going to do yet, but we did see that aid package on the House side. On the livestock side, the first challenge that we noticed and states were reporting was we needed to make sure, this was very early on, we had some of our livestock heavy states reach out and say, some of our meat packing plants are having trouble getting access to personal protective equipment because everything early on was going to the hospitals. And so you had workers that didn't want to come into the work because they were afraid of getting sick. And then once workers started getting sick, they started shutting down these meat processing plants. The executive order that was signed at this point, probably a month ago, the days start to merge together after 3 months of this, but the executive order did provide the authority to get more personal protective equipment into these meat packing plants. You see the plexiglass barriers in between workers. So we are starting to see the processing capacity come back in the beef and in the pork and poultry processing. Weekly cattle slaughter was only down 11% from year-over-year levels. A big rebound from a couple weeks ago being down as much as 30%. Same thing in the hog market. They were down, anywhere between 30 and 40% a couple weeks ago, and today are down about 8% compared to year ago levels. Now, the other thing to take into consideration is the weight of the animal. And so you talk about the number of animals we process, but heavier animals, because they've been put on a maintenance diet or grown out a little bit more because they couldn't get access to processing. We see beef production is down 8% from year ago levels. And year to date, because you had a lot of producers bring market ready livestock, I think for cattle folks in particular, the Holcomb fire is fresh on their mind. And they knew that there was a risk that these plants would be idle or reduce their processing capacity. So you saw in March, heavy processing of beef. So year to date, we're only down about 4%, even though we saw a pretty significant drop in weekly production output. On the pork side, again, heavier animals means year over year, we're only down about 6% in terms of pork processing. And then when we think year to date, we're actually up on pork processing. Now, you still had a lot of animals that are ready for processing. On the cattle side, they've got a longer feeding period than on the hog side, and so we did unfortunately have to talk with a lot of producers that had to euthanize animals, euthanize hogs, and euthanize poultry. So many of our poultry growers are seeing their flocks extended, so they're not getting as many flocks per year as they once were due to COVID. And so there is a provision in the HEROES Act. I would anticipate maybe something similar on the Senate side to help producers who had to depopulate livestock due to coronavirus. There's also some states are doing some individual initiatives. I believe Iowa has some money set aside to help hog producers. And then USDA's NRCS also has some money available to help for the disposal of livestock. But that was a pretty big challenge. It's obviously I'll show here in a few moments the impact to retail prices because of the supply shortages here in Washington D.C. For example, I've been unable to get ham for over 3 weeks. It's just not available in the local grocery stores. And so even though pork processing is up year to date, we do still see some shortages across the country, not widespread, but in certain pockets anyway. What this did is, on the meat side, you had two kind of counterbalancing supply and demand things happening at once. And on the retail side, the panic buying at the grocery store, many retailers were scrambling to get access to protein products. So they were bidding up the wholesale price, whether it was on the for beef or for pork, for poultry. You saw these prices getting bid up. At the same time, you had producers with market-ready livestock without a home. And so you saw their prices going down. And so that led to the packer margin, what we call it, reaching record high levels, the cattle live to cutout spread. And this has caused some consternation among farmers across the country, thinking that there might be some market manipulation going on. And we've communicated with CFTC and CME. Chairman Tarbert from the CFTC has called in and visited with President Zippy Duvall on a number of occasions. He's going to visit with our state presidents in July as well. But this is a particularly challenging issue that I believe 19 senators sent a letter to the DOJ asking them to investigate these packer margins. You saw the news yesterday with respect to pilgrims and price fixing, those indictments from the Department of Justice. But even though this live to cutout spread is record high, I think it doesn't take into consideration the cost of implementing social distancing rules in the plant, the cost of personal protective equipment, and the lower operating capacity. All of those are going to impact the marginal costs of running the operation, the marginal costs of production. So I think while this margin is very wide, it's not necessarily indicative of profits in the meat packing plants. But nonetheless, it's led to calls among farmers across the country to do something, to intervene somehow in the cattle markets, whether it means making sure that a certain percentage of the cattle in the U.S. are cash traded, whether it means reviewing country of origin labeling. I think in talking to a lot of our members, they're looking for something, even if that something may not fix the problem that we have in front of ourselves today. So there's a lot of angst in cattle country because of this particularly wide margin. But what we've seen, the impact on commodity prices from everything that we've talked about is, in mid-April, commodity prices were very, very low. Hog prices were more than 50% lower than where they were to start the year. Live cattle prices were 30 to 40% lower. The Class 3 milk contract was more than 30% below its January price. Cotton prices were 25% lower. Just about the only commodities in mid-April with higher prices were rice, and that's because we had a shorter crop last year, limited supply, and then there's more demand for some of that shelf-stable product for people that are cooking at home. In recent weeks, we've seen some of the commodity prices rebound. I think for the Northeast, dairy country in particular, you've now got a Class 3 milk price that's higher today than what it was before the coronavirus. And so I had a conversation this morning with Michigan Farm Bureau and their insurance company. And what I told the dairy folks on that call was, in March and in April, my phone was ringing off the hook from dairy farmers asking for some kind of assistance, asking to reopen dairy margin coverage. And those that had dairy revenue protection were so thankful. And the market has given you an opportunity from a dairy risk management side to put protection on again. And you never know the uncertainties that lie in front of us. And so with a June milk price that's higher than it was in January, with continued strength throughout the rest of the year, there's an opportunity to lock in and protect against lower prices in the future by using dairy revenue protection. I know that folks, Farm Credit East is worked very well with us on dairy revenue protection. So working with them to put a contract on, pretty useful given the rebound that we've seen on milk prices. USDA, if we look, across the major commodities and we compare both the change in old crop value and the change in the new crop value from expectations before and after coronavirus. And this is just for the top 8 commodities, not everything, not specialty crops, not lamb, not wool, not feeder cattle, just the top commodities. We're looking at nearly 60 billion in the lost value of commodities. The dairy industry's been hit especially hard with nearly 17 billion. Again, this estimate was prior to the price rally. So when we get the next USDA world supply and demand estimates, these numbers are likely to change. But you can see the impact on dairy, you can see the impact on poultry, you can see the impact on beef, corn, soybeans, pork, cotton, wheat. Everybody's expected to see lower returns for the most part due to the coronavirus. To provide some immediate assistance, the CARES package provided a $2 trillion package, provided about $50 billion to food and agriculture. More than half of that was in child nutrition programs and additional funding for SNAP. And that's going to be useful to help fight food insecurity when you have 40 million people unemployed across the country. The other half of that, $9.5 billion to the Office of the Secretary, and then $14 billion in CCC replenishment, are going to be used to craft aid packages for producers. The 9.5 is going out now, in addition to 6.5 billion for a $16 billion coronavirus food assistance program that's going to provide direct payments to cattle producers, dairy producers, specialty crop producers, and non-specialty crop producers. The remaining 14 billion will be available later this summer to craft additional assistance packages. And then we're also working on Capitol Hill. Farm Bureau is working on Capitol Hill right now to get the Commodity Credit Corporation's borrowing authority increased to 68 billion. And that would give the Secretary of Agriculture the resources he or she may need in the future, as well as for the Secretary today, to craft any assistance packages that could be needed to help stabilize and support farm commodity income and prices in the future. So we're working to get that CCC borrowing authority lifted. The CPAP program that producers sign up opened after Memorial Day. It's open through August 28th. For non-specialty crop producers, you have a CARES payment rate and a CCC payment rate. The total payment is the average of these two multiplied by half of your 19 production or your inventory on January 15th, whichever of those two is lower. So it's designed to provide assistance to producers that for any unpriced grain that they may have had. And so for corn, it's 33.5 cents. For soybeans, it's 47.5 cents. Cotton, it's 9.5 cents per pound. Wheat, certain varieties of wheat, anywhere between 19 and 20 cents per bushel. So all this money is going out now to producers. They need to go and complete the paperwork with their local FSA offices to get this assistance out to them. For the livestock side, we see slaughter cattle getting $214 for any animals that were marketed from January 15th to April 14th, I believe. And then anything, the highest inventory level that a producer had from April 15th through May 14th is eligible for the CCC payment rate. So for a dairy producer, if you had a cull cow that you sent to slaughter sometime in the first quarter, you're going to get $214 a head. And then for any non-milking cow on the farm in inventory, you get $33 a head. So there's opportunities available for farmers with cattle to get direct assistance. This is the first time the cattle producers have received a direct payment, to my knowledge, through USDA. For dairy farmers, they get what amounts to be a $6.20 per hundredweight payment based on their first quarter milk production volume. Across all the CFAP programs, there's a payment limitation of $250,000. 80% of the payment's going to be paid up front. So anybody maxing out their payment will be able to get $200,000 right away. So for a dairy operation, that amounts to be about a 700 to 800 cow operation needed to max out their CFAP benefits. Specialty crops are also eligible for funding. So there's 3 different types of payment rates for specialty crops. I'm not going to go into all the details here, but folks will have access to these slides, and then more information is available at farmers.gov/CFAP. But you can see assistance is available for sales losses. Assistance is available for product that left the farm but was spoiled. So there's various types of assistance available for specialty crops. All told, the $16 billion that's set to go out to farmers, about $4.4 billion is going to be delivered to cattle producers. Dairy is about $3 billion, specialty crops 2.3, hogs 2.1, and then the other commodities, there corn over $1 billion, soybeans 700 million, and cotton producers about 400 million. For folks that didn't see their commodity listed under the CFAP, there's an opportunity to petition USDA to have your commodity covered through a notice of funds availability. Farm Bureau, we're working with our grassroots members across the country to get the type of data that we're going to need to demonstrate to USDA that additional assistance is needed for any commodities that were left out of the CFAP program. So, for example, alfalfa is not currently listed, but producers may be able to demonstrate a price decline on alfalfa and get it reconsidered under the CFAP program. So we're actively working on that. We also had the Farmers to Families Food Box program. $1.2 billion in contracts were awarded by the Department of Agriculture to help get some of the surplus product around the country, deliver it to needy consumers. Fluid milk, 187 million, dairy products, 134 million, more than 300 million in dairy product purchases through this program alone. Fruit and vegetables, big beneficiary as well. So this is designed to help keep the supply chain moving, find a home for that surplus product, and USDA still has about $1.8 billion in additional money left to do more of these food assistance type of programs. All of this with the coronavirus is happening at a time when the farm economy was already in pretty tough shape. When we look across the country over the last 12 months, we've seen Chapter 12 bankruptcy filings increase by 23%. We had 627 filings the last 12 months ending in March. And that's the 3rd highest total that we've seen over the last 20 years. It's well below what we saw in the 80s, but it's a very concerning trend. And that's before the coronavirus. And what concerns me in thinking about the current situation in the farm economy is what we see now with, today unemployment claims were 1.2 million. Over the last few, month or so, we've got 40 million people, I believe 40 million unemployed. The April unemployment rate was nearly 15%. That's going to have an impact on off-farm income. And when I talk to folks in the lending community, and I'm sure many of you, their farm credit understand this and are studying this very closely. But the last time we had off-farm income take a dip during the recession, and make no mistake, we're in a recession today due to the coronavirus. We saw off-farm income decline, and we saw farm loan delinquencies rise to the highest levels that we've seen in some time, between 3 and 4%. Now, that's not anywhere near what it was, in the 80s, but it is a concerning trend that could lead to higher delinquencies, higher bankruptcies, if we do not sufficiently help the farmers and ranchers impacted by coronavirus. So we know more assistance is going to be needed to help bridge the gap. The $16 billion in direct payments that we're getting now, the Secretary's acknowledged that it's not enough. So I do anticipate more assistance packages coming in the months to come. And it's going to be needed because farm debt is record high, $425 billion. If we adjust for inflation, it's only slightly lower than what it was in the 1980s. I think what's helping agriculture currently is the very, very strong asset values. Land prices remain strong. That keeps some of our financial ratios from getting out of control. We can have record farm debt, but when our asset value is over $3 trillion, that keeps the debt to asset ratio relatively low compared to historical levels. But things are still moving in the opposite direction. And I would anticipate, 2020 farm income to really depend on what type of assistance packages USDA is able to create and deliver to producers. I think there's more uncertainty when you think about the new crop that's going in the ground now, the demand uncertainty that we have, next year after harvest is very real. And one of the things that I've been thinking a lot about, and I think folks have been thinking a lot about, is the Phase 1 agreement with China. And under the Phase 1 agreement with China, China's supposed to buy somewhere in the neighborhood of $30 to $40 billion worth of products this year and next year. And the rhetoric with respect to China, the rhetoric around Hong Kong, this week we've seen conflicting reports that say, the Chinese are canceling their purchases, ordered to stop purchasing pork and soybean products from the United States. But then we've also seen some purchases for October, November delivery of soybeans. So I think all eyes are going to be on the Phase 1 agreement with China. This information just today, moments before this phone call, webinar, USDA released updated export data to China for April. We see April exports to China at more than $1 billion, up sharply from March. We're now on a path to export. USDA's projection is for fiscal year exports to reach 13 billion. We're on pace for about 11.5 billion right now, so we still need to accelerate, the latter half of this fiscal year to meet our Phase 1 commitments. But make no mistake, when they've purchased about $4 billion worth of products through the first 4 months of the year, that's a long way away from their Phase 1 target of 30 to 40 billion. And so this is the exact same chart as this one, but just put into scale of what would need to happen in the fourth quarter to reach our Phase 1 commitment. So Chinese purchases need to accelerate. They need to accelerate in a big way. That's going to be one big demand driver for agriculture. I think ethanol production rebounding and ethanol use in 2021 is going to be key to supporting corn prices. I think thinking about, how many acres did we just plant of corn and soybeans? We'll get that information on June 30th with the acreage report. But looking at the weather conditions, we've had an excellent pace of planting for corn and soybeans across the Corn Belt. If we continue to have favorable weather, we could see a really big crop, a bumper crop. So demand's going to be key to work through not only old crop supplies that were hampered by coronavirus, but also the new crop that we're going to harvest this fall. On the livestock side, what was once expected to be record production of red meat is now looking like it might be slightly lower than 2019 levels. I think we'll see the markets recover a little bit in 2021, but it is going to be difficult. Not yet. When you have a 5-year-old in a webinar, sometimes you have to interrupt yourself. I apologize. But for 2021, in terms of livestock production, I think we'll see. A lot will depend on the capacity that these processing plants are able to operate. I think we're going to continue to see personal protective equipment heavily utilized in these plants going forward. So they may not be able to return to full 100% capacity. So I think that's something to monitor on the red meat production. On the dairy side, I think we just don't know yet to what extent the co-op and milk processing supply control programs are going to have an effect on milk supply. We've seen cheese prices reach record high levels. I believe block cheese is the highest level that I've seen, over $2.50 per pound. So there's very, very strong demand there, at least in the short term. But I think until we get a clearer picture on what supply looks like in the dairy space, we don't know what prices and production output are going to be in 2021. But there's certainly a lot of uncertainty on the horizon. With respect to coronavirus, the assistance that we're going to get, what kind of crops we're going to have. But hopefully we can move past this and things will start to get better. A lot of the information that was presented during this webinar, we do make available on our website at fb.org/market intel. We put out timely content 2 to 3 times per week on issues from a market perspective, as well as from an ag policy perspective. We released an update 2 days ago on the Paycheck Protection Program, the bill that was passed out of the House and adopted by the Senate, on what those changes were. And in the 2.5 days that it's been on our website, it's been read over 5,000 times. So if you haven't been to our Market Intel website, I would encourage you to visit it. And I really appreciate the opportunity to be with you today and look forward to any questions that folks may have.
Okay, thanks, John. We have a few questions here that should be interesting. One, this is going to require you to get out your crystal ball a little bit. How long do you think it'll take for the economy to rebound to normal? And what do you think, what impact would a second wave of COVID infections have on that?
I think that's the $1 million question. I think you can find certain sectors of the economy that's going to have a V-shaped recovery, and some may have more of a Nike swoosh recovery. So I don't think there's any crystal ball that's going to tell you how exactly it's going to unfold. I had a call with some folks from the airline industry that don't expect airline traffic to get to pre-COVID levels for 4 or 5 years. You can see auto sales starting to recover here in the United States. But for ag, one of the things to think about is even as states begin to reopen, restaurants are not going to be running at 100% capacity. They're going to be running at 25, 30, 50% capacity. What are they going to need to do to make their margins work? Are they going to have to pass on higher costs to consumers? I think we're going to see higher costs at the grocery store at a time when we're in a recession. I think that could have an impact on food expenditures here. So in terms of economic recovery, I'm optimistic that things will pick back up, but I think it'll be a while before things look like they did before coronavirus. I mean, just as an example, all of the safety measures that are being put in place here in Washington, D.C., just to have offices reopen. We don't know yet if schools are going to be reopened in the fall. So that's going to weigh on our ability to recover quickly from this.
Yeah, fair enough. Another question that you sort of answered in your presentation, but I'd like you to maybe expound on it. Is do you think that the situation of supply chain disruptions has gotten better over the last, perhaps couple 3 weeks compared to what it was at the very beginning of COVID when we lost the food service markets virtually overnight? By that I'm saying is, do you think that the big bottleneck was like basically processing for ag commodities, and do you think that supply chain is managing to start to adjust to the new situation and things have gotten somewhat better or not?
Well, I think you can't discount our way to innovate and solve a problem. So I think we have seen supply chains adapt and become more flexible. You've seen food distributors open their doors to consumers. You've seen excess cold storage being utilized. So I think everybody's working together to try to solve the challenges that we have. And one of the things that we've done at Farm Bureau was help plug people together. Resources that some people have, letting them know they're available. I think UPS has had resources available to be able to help farmers deliver to consumers. We plugged that Coyote initiative together with our state farm bureaus. So all types of innovative new solutions are being adopted across the country to get these supply chains up and running. And then I think once this is behind us, I don't think there's a sector of the U.S. economy that's not going to look back on this and say, how do we make our supply chain more resilient? Do we need to build in some shock absorbers in our supply chain? It's going to continue to be efficient, but are there things that we could do to address some of the blind spots we had before us? And that's every sector of the economy.
Okay. I have perhaps a rather detailed question for you here. You mentioned the HEROES Act, and while the Senate has indicated it won't take up the overall bill relative to the ag provisions in the HEROES Act, do you think any of those might be included as the Senate works on its next COVID relief package? What are your expectations for new ag provisions in that next package?
The HEROES Act had some things that I think, we know that we need to help folks that depopulated animals. The HEROES has something in there. It adjusts the Commodity Credit Corporation's ability to help depop. We saw the Stabenow bill on trying to streamline food donation programs. We've seen in the HEROES Act, there's an initiative to help the ethanol producers, help the textile producers. There's a provision in the HEROES Act. There's $16.5 billion in direct support in the HEROES Act. But the challenge with the HEROES Act is it was it was a partisan bill. It was not bipartisan in nature. I think the Senate is going to perhaps pick up some of the provisions in the HEROES Act with respect to agriculture. I know my colleague, Andrew Walmsley, was just in contact with McConnell's staff, and they understand that agriculture needs more assistance. And we've been advocating to get the CCC lifted to $68 billion. And that would give the secretary the resources he needs to craft assistance packages in the future, whether it's for COVID or whether it's for future trade damages in the event that the phase one commitments aren't met. So I know we're going to see ag in this next package, but what it all looks like, I think, is still up for debate.
Okay. I have a question for you that's it's not strictly a COVID-related question, although COVID, I think, has affected the issue a little bit, is about COOL, country of origin labeling for meats. Obviously, this brings into issue of international trade, and there's treaty impacts there and everything else. What are your thoughts on the country of origin labeling sort of controversy, if you will, and does AFBF have an official position on it?
On country of origin labeling, I think, the challenges with mandatory country of origin labeling are well documented. We're going to have I gave you the market intel website moments ago. We're going to have an analysis on MCOOL next week. So I'm not going to steal all the thunder and give it to you now. You're going to need to come to the website and get that analysis. But at the end of the day, I think that the situation is folks looking at MCOOL, they're looking at it to solve the problem, and it may not solve the problem that they think that we have today. I mean, there are WTO implications with it. It may not necessarily lead to higher prices here in the United States. And there's no evidence that mandatory country of origin labeling stops imports. I mean, we have mandatory country of origin labeling on fruits and vegetables, and it hasn't slowed the imports of those products into the United States. But I'm going to stop there and not steal too much thunder. That's just a teaser. You'll have to come read the article on the website if that's okay.
Fair enough. Excuse me. Do you have any thoughts as far as where we go from here? Do you think that the food supply chain is going to sort of be permanently altered by this COVID-19 experience, or do you think we're kind of going to snap back to normal within after a sort of an adjustment period?
I think it's going to take time. I mean, I think a lot of it's going to depend on confidence of the consumer to get out, sit back in restaurants, be in highly concentrated areas. I think a lot's going to depend on, what business reopenings look like. Maybe there's a vaccine that's developed, but I think that, on the other side of this thing, everybody's going to look at their business and think about what they need to do to modify in a post COVID world. For food processors, maybe it's investing in increased mechanization. So, I mean, I think everyone's going to be studying this. This is a case study. People will be studying this for years and years, Chris, to figure out what we can do and do better as we move forward. I was on a call with the United Nations Food FAO last week, and one of the things they talked about is increased mechanization, more e-commerce delivery of food. Those are some things to look forward to. And then back to your earlier question on what happens if there's a second wave. The wave is still going in some parts of the world. Mexico, they've not flattened the curve at all. Brazil, they've not flattened the curve at all. So I think what we're going to see, however, is even if there's a second wave, I don't think we're going to shut down the U.S. economy the way we did in March. I think we'll try to contain it, continue to use PPE and continue to social distance, but I don't think we can take another hit to GDP like we've done again with a second wave.
Okay. Question about USDA Farm Service Agency, and I guess it would apply to any USDA agency. They've been challenged to administer CFAP and other programs, given that their offices are typically closed to most visitors. What are you hearing relative to how signups are going for that program?
I've been in constant communication with many of our state farm bureaus. I think growers are getting their paperwork, ironed out, getting questions they have answered. We've got a call tomorrow with FSA Minister Fordyce. We've had Undersecretary Northey visit with our states. They've been very open with us and open in communications to help answer our questions as we move forward. So I haven't heard of any challenges with producers at this point, but FSA does have a Herculean task in that there's going to be a lot of producers coming to their door that have never really worked with an FSA office before.
Yep. Question, sort of a clarification question came in relating to off-farm income. Could you comment sort of briefly on what that typically consists of for most farmers and the significance of it for the average farmer?
In terms of net cash farm income?
Yeah, the off-farm income portion specifically.
Oh, the off-farm income. So off-farm income would be, if you have maybe one of the spouses works at the school or the hospital, or maybe somebody farms and works at Farm Credit, or they work at the university. That's what I mean by off-farm income. Okay.
And I think that, particularly for a lot of smaller farmers, that's a critically important part of the household income.
For small and intermediate farms, they rely pretty heavily on off-farm income. Your larger operations are the ones that get more of their income from the farm operation.
Good. Another question for you relates to the specialty crops, which for those that aren't familiar with that term, that's USDA speak for basically fruits and vegetables. Not all of them got a Category 1 CFAP benefit. Like, for example, apples, they're eligible for, if they shipped and didn't get paid for product, I believe, or if product spoiled, they could get payment, but there was no price decrease payment, if I'm understanding it correctly. And I think they're not the only specialty crop in that situation. Do you know if there's any sort of adjustment or negotiation happening on those areas, and what's the process?
So what would be needed in for any of the state farm bureaus on the phone or any producers that are Farm Bureau members, we need data to demonstrate the price decline. So I think FSA is open for specialty crops to redesignating some as Category 1, but we just need to give them the data. And so we're compiling our notice of funds availability comments. The comments are due June 22nd, but what you're going to need is clear data to demonstrate why it should be Category 1 as well.
And I think there's a bit of a challenge there in that some of these crops that don't have markets where they're traded, there's not always a price change. Sometimes it's just lost sales. Like the price is what it is, and you either sell it or you don't. How do you think they're going to be able to address that?
Pulling together any records that you have is going to be key. We just need some sort of data. If you can work with your local farm bureau to work with us and give us the data, and we can try to build the case. I mean, that's ultimately what we're going to need. If we don't have any data, if we don't have data, there's not going to be anything that we can wave at USDA and say you need to help these folks.
Great, thanks. So I think we're going to basically wrap up the webinar today. But before we go, I want to mention a few things. One is our COVID-19 resource hub, which is on the farmcrediteast.com website. It's under the Knowledge Exchange banner, or there's a link there on the screen, farmcrediteast.com/resource hub. That's a page that we're keeping frequently updated with all of the relief programs that John talked about today, as well as some others like the Small Business Administration programs. And as changes come out, which there frequently are, we are updating with new information as quickly as we possibly can. So that's a good web page to visit often. Another is that this is one of our series of spring webinars. We have several more coming up. We're going to be covering forest products, beef markets, and animal protein markets, fruits and vegetables, and some other topics. All of our webinars, past, present, and future, live at farmcrediteast.com/webinars. So if you want to peruse what upcoming webinars we have are, and perhaps sign up for future ones or access the recording of past ones, you can do all of that at that page. I would also like to plug and thank the State Farm Bureaus who co-sponsored this event. Thank American Farm Bureau, who we have a great relationship with and who are very generous in giving us John's time and efforts to present here. And I guess that's all I have to say. Do you have any final thoughts, John, as we kind of wrap up?
No, I just appreciate the opportunity to be on the webinar today, and I think thank the Farm Credit for everything that they do for the Farm Bureau, and I appreciate working with you all.
Great. So with that, thank you very much again, Dr. Newton, and we are adjourned.